and welcome to the third webinar in our series of Grow Your Law Firms, and today we're going to be talking about how to grow your cash. And I'm sure you'd all admit that over the last few years cash has been a little bit tighter in working with clients, probably also within your own firms as well. What most people don't get though is that cash is just another system that you need to develop and work on in your business so that you can be in charge and control the outcomes of your cash flow management. So that's what we're going to cover off today. So welcome everybody, and thank you very much for attending today. For those of you who have participated before, you'll know that this webinar is being recorded. And after the webinar, some stage throughout the afternoon, you'll receive a link so that you can go and listen to it again if there are bits and pieces that you wanted to revisit. Just before we get started, I would just like you all to consider joining me at our workshop, Grow Your Law Firm workshop, on the 17th of October here in Brisbane at 2012, 9 till 1. If you wait till the end of the webinar, there's a special offer that's going out today. We have this this workshop program for a 25 seat maximum. So just watch this space to the end of the webinar. What we're going to be covering off in the workshop is basically this in a more detailed way. And in an interactive way where you'll have me for 4 hours to go through in more detail each of the three webinars content that we've had. Charging hours is only part of the revenue equation, building a revenue pipeline, and growing cash. In the workshop, we will review where your firm is up to and help you develop clear strategies to implement to improve your revenue and drive your cash flow forward. So I thought we might just cover what we've gone through so far in our last two webinars. So just before we get into it, I'd just like to get a bit of a feel for who's participated in webinars so far. So I've just launched a poll there. So if you could just click whether or not you have or you haven't, just so I can get a feel for how much detail I've got to go into in this particular webinar. So I'm not going over too much ground for those who have already participated. So thank you very much. We have about 2/3 of the attendees today are new webinar participants in the Grow Your Law Firm series, and about 1/3 of you are coming back again. So that's great. Thank you very much for your support, and I hope you continue to get some great value out of these webinars. Also, just so I can position properly the work that we're going to go through today, if you could also just give me a little bit of an indication around what describes the firm that you currently work in. I mean, is it a sole practitioner firm, 1 to 3 principal, 3+ principal firm? So it looks like we've got a pretty good mix here today. We've got 44% of participants work in sole practitioner firms, 38% in 1 to 3 principal firms, and 19% in 3+ principal firms. And lastly, and then we'll get into it, I'd like to just get a feel for what best describes you. Are you a principal? Are you a solicitor that's a non-principal, or CEO or practice manager? Fantastic. So thanks very much for that. We've got about 59% are principals who are with us today, 10% solicitors, and 31% in practice management. So once again, thank you all for your participation today. What I'm going to be doing in this webinar is a little bit different to what I've done in other webinars. I'm going to try to finish up about 5 or 10 minutes early and then open up the lines for any questions that you may have. So if as we're going through today, you've got some questions that you'd like me to answer, we will just wait till the end, and we'll give you that opportunity. So what we've covered so far. Basically, when you look at your strategy in your firm, you've got to have a look at it in terms of your overall strategy. And what we call that here at Elliott's is being financially well organised. And we're focusing specifically here in this webinar on your business plan. When you look at your business plan, we break that down into a number of different areas. And the area that we're focusing on today is your financial management systems. And in doing so, we're going to look at different strategies and different actions that you can implement in your firm to improve your cash flow. But just to recap a bit more on where we've come from. Most firms work in this environment of what I call squeezing the orange. Day to day, you're spending your time working in the production and delivery part of the business, that is doing the work, and getting those files completed, and then in an ad hoc way you do other revenue activities, and those revenue activities might be a little bit of marketing, or working with a centre of influence, or writing an article, or doing an advertisement, or something like that. But it's very ad hoc, and I call that squeezing the orange because the formula that most firms use in developing their revenue and measuring their revenue is built on this formula of number of full-time equivalent fee earners, how many hours do they work, how many hours do they charge, what's their charge rate, recovery rate, and then what the direct labour cost is to work out how much they make before they have to pay their overheads. So that's a very normal formula that's used in not just law firms, but professional services firms across the world. And it's very valid, and it's very important, and it has its place. But what it does, it actually creates some of the wrong behaviours and some of the wrong focuses in a firm. And we're going to cover off some of those very quickly shortly. But for those of you, sorry, I just realised that I'd left the last results up on the screen. So for those of you who are principals of businesses, or even if you're not, I'd just like to get a bit of an idea if that is the formula that you use in your firms for determining your revenue. And you know, it's a very normal formula. As I said, it's been around for ages. It's called originally it's called a time costing system. So it beats me why we still use it to measure revenue when it's based on cost. But thanks very much for that. You know, 76% of the participants today have said that they use that. So roughly 3/4 use that formula, and there's another 24% that don't. So what I'm going to be proposing for you today is just to have a look at an alternative method, not for measuring and recording your income, but for how you do your planning. And it's very difficult to plan using this current revenue formula that's on the screen because what you're focusing on is only being able to generate more revenue by having more people charging more hours, and that's why I call it squeezing the orange, because eventually that orange will run out of juice, so you've got to buy some more oranges. Instead, you should be focusing on this formula, and this is in terms of your planning. So I'm not saying ditch timesheets, I'm not saying stop recording hours, I'm not saying don't bill your clients that way. I'm talking here about how you plan for your revenue. And this is how every business in the world generates their revenue, including law firms, including accounting firms. Basically looking at the number of clients they have, how often those clients use the firm, how much they spend each time, and then how much they make out of each and all transactions which is basically the difference between the revenue minus the fee and the labour cost, and that produces a gross profit. So my challenge for you today is to start thinking about those numbers in your firm, not just focusing on how you do the work, but also focusing on how you generate the work. And instead of applying this two-level squeezing the orange strategy, which is just about having to do the work, do the work, do the work to generate revenue, you need to actually apply some other plans and other strategies in your business to support and create your revenue generation strategy. And those strategies rest within your product, your marketing activities, your sales. Production and delivery is very much just around how you do the work and how you manage the relationships. If you're looking at your revenue, these first three components of this revenue strategy is what drives your revenue. So those three areas are product, marketing and sales. So unless you actually have signed that client up to do work, you're not going to make any money out of them. And that's basically the driver of this revenue formula of number of clients times average trend by transaction value times average sale. If you don't sign the clients up, you don't do the work. But where we spend most of our time in measuring revenue and generating revenue is in the doing. And all that does is drives your margin. But more specifically, the production and delivery area of your business, which is where you do the work, which is the basis of your squeezing the orange, charging hours formula, only can generate efficiency margins. It doesn't generate actual revenue. So what you've got to be thinking about in your business is what those actions are. When you combine the two of those concepts, the revenue strategy and the growth equation, there are specific strategies that impact on specific areas of the growth equation. So if you wanted to increase your transaction frequency, for example, you need to be thinking about what's our product strategy, what are our marketing strategies, what's our sales strategy, CRM, and so on. But your current revenue formula only focuses on the production and the delivery. How many people, how many hours, at what rate, at what recovery, so write-ons and write-offs, produces the revenue. An interesting, just a little comment here. In terms of firms that purely focus on the current revenue formula of hours, on hours basis, I make the comment to them often that the most bad debts in those firms are actually written off even before the time hits the timesheet, not necessarily when a bill is done. And if you've got a firm that has their productivity of their employees, their fee earners running at 65%, and they rely on that production of that work to generate their revenue, then they're not even, and that might be as a result of them not even doing the work but not charging it, they're actually writing off all of that potential revenue before they even do the work. So with your current revenue formula, it's actually flawed in terms of driving specific actions to grow revenue, where the revenue growth formula, where you focus on client numbers, transaction frequency and average sale, you have a whole range of other alternatives for growing your revenue. So being a chartered accountant, I bring everything back to numbers, and for those of you who listened into the charging hours is only part of the revenue equation webinar, this was the formula and the calculations that we worked through. So it shows that where you can make slight improvements in each of those items, number of clients, transaction frequency and average sale value, if you make slight improvements, then it can have a significant impact on the revenue that you generate. And that for a lot of firms, when they look at their numbers like this, they see, well, hey, I didn't really realise that was the case. I have one One firm that stands out as a good example over this year that I've been working with, and when we sat down and had an analysis of their revenue, they had about 6 different practice areas. One of those practice areas had an average sale of about $16,000. That average sale was made out of about 10% of their transactions for the year. The balance of the transactions for the year, so 90% of them, they had an average sale of about $850. So we then had a look at what the strategies need to be to drive up that average sale in those other areas of the practice to drive their profitability. And if you think about it from a cost perspective, a lot of the costs that were incurred in the firm were required to drive and manage that low average sale parts of the practice. Mind you, the practice revenue represented about 50-50 in that firm between that one practice area and the other areas. When we have a look at that charging hours formula though, you can see that it's very important to still assess that in terms of your capacity. Have we got enough capacity to do the work? What's our current productivity? How can we improve that? Can we improve our charge rates, to determine if we've got enough people to do that work? What we then moved on to in the second webinar is really looking at how to then drive revenue growth. So if we've got these strategies that we're implementing here around driving revenue, product marketing and sales, we then need to have systems and processes to do so. And what I found in most firms, and it doesn't worry me whether they're a law firm or any other professional services firms, and really most businesses that I've worked with over the years, they have this focus on finding new customers and new clients. They're constantly looking for new clients. Law firms in particular focus on new clients simply because they feel that they need to keep going and looking for more and more to generate more and more transactions. But the gold mine that exists in your firms are within your existing client base. If you're a specialist firm, then these opportunities are a little bit more limited. So if you're a PI firm, you may be limited in terms of providing additional services to existing clients. But for most firms, there's a gold mine exists in selling additional products and services to existing clients. A couple of observations on that. The first one is that existing clients are easier to generate work out of, and existing clients who have already bought something from you, where they might need to revisit that product, say maybe like their will or estate, or they've looking to buy another property. They've already bought that product from you or that service from you, so you're able to. It's easier to sell to them. It's easier to generate that revenue. So I say to clients, the first place to start is looking at what you've already got. Start looking to engage your existing clients to buy existing products and services from you. Second easiest thing is then to sell existing products to new clients, because you already know those products, then you've just got to find the new clients. And lastly, the hardest thing is selling new products to existing clients and new products to new clients. Creating new products is a very timely, expensive and uncontrollable thing. It's untested. You don't know what the outcomes will be. So in the essence of developing strategies in your firm to grow it, you need to be focusing on your existing clients first. And when you have a look at your revenue, you then need to understand where your revenue comes from. There are only 3 different types of revenue. That's recurring revenue, reactive revenue, and proactive revenue. When you have recurring revenue, that's things like retainers, and in most law firms, that doesn't exist. Reactive revenue is client-initiated revenue. Mind you, this is revenue that you can't control and you can't quantify. You don't know when a client is coming in. You don't know what transaction a client is going to do. You don't know what help a client needs from you. Then you've got proactive revenue. That's where you actively develop and implement strategies around your product marketing and sales in your business to drive revenue into your business. So you actually can control that. And for those of you wondering why there are these glasses on some of the screens, they're there as a reminder, a prompt to me to ask you a question. So I've just got a very a quick poll here to do again, and that's just asking you where you get your revenue from. Does your revenue come from mainly from recurring revenue, or does it come from proactive revenue strategies that you implement in your business? Or is it reactive? Do you basically wait for clients to come in? So when I'm talking about recurring revenue, I'm not talking about revenue that clients from clients regularly coming back to you. What I'm talking about there is where you've got locked in, say, a monthly retainer. So thanks for that. We'll close that poll, and this is a very normal sort of result whenever I ask this question in groups of law firms. Generally, it's about 2/3 of law firms generate their revenue via reactive revenue streams. In this audience, the recurring revenue is quite high there, but it's always the case that the majority of revenue is the revenue that we just have as client-initiated revenue. But the key to driving and growing your revenue and improving your cash flow and growth in your firm is to implement strategies that focus very much on proactive revenue. So when you then look at creating strategies around proactive revenue, you've got 3 areas that you focus on: product, marketing, and sale. So what's your product? Your product's basically what you're good at, what you're passionate about. It's the things you focus on that you like doing. I say to firms, work out your top 3 things that you like doing and that you're good at, and then you should focus your product development strategies on those and look at selling those to your existing clients. And why product definition is so critical in the development of your revenue plan is that it communicates your message. So if you've got clarity around what your product is, the marketing messaging is so much easier. Also, because your messaging is clear, it creates awareness in clients. So if you've got clear product definition, you can get the message out to people and your clients will understand what you are wanting to do with them in a much clearer way. You've got to remember also in your firms you can't be all things to all clients. You know, this broad brush approach of being able to do anything for a client, it's just way too hard and it's very inefficient. What's marketing? I call marketing a tap. So marketing's just a tap that you must have constantly running. It's a bunch of different activities that you do to feed work into your business, both from existing and new clients. But what most people do is they turn the tap on when they need work. Instead, they should just be having it running all the time and turning it down as the work gets a bit too much. What you should also do is have a sales system in your business that you constantly follow, that you can produce predictable outcomes when you close your sales. So that's basically a focus on what we've covered off so far. I encourage you, for those people who haven't participated in any of the webinars so far, go onto our website at elliotsgroup.com.au, go to our blog, and in there we've got recordings of the last 2 webinars which go into that in a lot more detail. So I probably went on a little bit too long there for my own liking. Now we're just going to get into cash. And what most people don't understand in their firms is that they can actually control the flow of cash in their business, and the things that cause speed bumps along the cash cycle are things that are outside of your control. What you've got to do though is you've got to create systems in your business that you can control, so that those speed bumps just become a minority of occurrences. And those speed bumps I'm talking about are things like clients paying their fees late, things like downturns in economy and so on. But if you have strong systems and processes in your business around your cash flow management, then you should never have cash flow issues in your business. So this is what I call the cash gap. And it's the period of time between when a cost agreement is signed and you receive the cash. Now I've just got some numbers there. Those numbers aren't taken from anywhere, they're just to use for illustrative purposes. So with with these numbers, they break up the cycle of the period of time between you sign your agreement and you get your cash. So in the first section is that 15 days there. It's a period often between when you sign a costs agreement and you commence the work. Then the next period of time is when you do the work, then you finish the work and issue a bill, and then you get the cash from a client. So professional services businesses are very much labour intensive. Our biggest expenses are wages and rent, and often then after that we've got leasing. In some instances there's some debt costs before we get into our general overhead. But what we have to do with these is we have to usually pay these without any credit terms. So, you know, wages are due every week or every fortnight. Our rent is due often at the beginning of every month in advance. So we pay these costs as we're going along. We've got these outlays of cash that are going out. But we've got a period of time here of 105 days between when we sign a costs agreement and we receive the cash. But in those first 60 days, we've actually spent money on wages, rent, other overheads, whilst we're doing that work. So there's a significant lag. So the key in a business is to develop and implement strategies to reduce that cash gap. And that's what we're going to be talking about now. I call that, that's usually represented in firms by what's called lockup. And lockup is basically the revenue that hasn't been billed and or collected, so it's your work in progress and your debtors. What a lot of people don't understand is that you've got to actually manage both of them, and you've got to manage both of them in a way that brings that cash gap down, so that brings that cash receipt forward. And you can do things to make that happen within your WIP cycle, so within your 15-day part of that cycle, within the next 45 days while you're doing the work, and then after you've issued the final fee, to actually pull those days down. So just to give you a little bit of an overview, and once again, I'm a chartered accountant, so I do bring everything back to numbers. So I just want to give you a little bit of an understanding of what this lockup means to your business and the impact that it has on cash flow. So what your lockup days is, it's a formula. It's the number of days in a normal 12-month revenue cycle that your revenue is locked up. And how you work that out is you take your debtors balances, your WIP balances, put them together, divide that into the revenue that you've had for the last 12 months and multiply it by 365, and it gives you days. So I'm going to show you an example a little bit later on and how these calculations work and the impact that it has. But in this example, if you had a firm that had $950,000 worth of revenue and had debtors of $162,000 and WIP of $195,000, that means that their lockup days is 130 days. So if we go back there, that is the period of time between when you start charging work to a client and when you finally receive your cash. So that means that there's, I think that number is $357,000 of revenue that is locked up in potential cash that hasn't yet come into the business, or it's 36% of revenue. Now, when you're looking at it from that perspective, that is a massive amount of revenue that could drop back into your business. And it's all relative. You know, if you've got a firm that's got $9.5 million worth of revenue, so often those firms have got much higher WIP and debtors balances. Exactly the same rules apply. So just another little quick poll. If you were to do some numbers yourself right now, looking at that formula, and you thought of, well, what's the amount of our revenue, what's the amount of our WIP and debtors balance, what percentage of your revenue would you have locked up? So is it somewhere between 0 to 10%, 11 to 25, 26 to 50, 50 to 100? or more than 100% of 1 year's revenue, and that's often the case in litigation firms. They have quite a significant amount of revenue that's locked up. So don't be too technical about it, just whatever you reckon. So we're seeing a really good spread here of WIP. So thanks for that. Looking at those results, it's about 22%, let's say about 0 to 10% of their revenue is locked up. That's sensational. That is really good. So those firms must have some good cash flow processes. 37% are somewhere between 11 and 25. So if that was 25%, that means a quarter of their revenue is locked up, with 30% being 26 to 50. So if we looked at the two main results there, we've got about 2/3 of the participants here today have WIP or WIP and debtors locked up at about somewhere between 10 and 50% of their revenue. So for those of you at 50% of your revenue, I'd expect that you have some cash flow issues that you're constantly needing to consider. So moving on. So that's the cash gap. What you then need to think about is, well, what do we do in our business to get that 105 days down to 75 days? Now, once again, I'm just using these numbers for illustrative purposes. Your days will be what your days will be. But what I'm saying here is that you need to actually implement strategies that are going to drive those days down. And you can design your system however you want. This is just as an example, and I know of some firms that use this system. But basically, your business cash flow systems can be whatever you want them to be. Just because there's a norm in the industry for signing a costs agreement, doing the work, sending out a fee, doesn't mean it has to be that way. But what your goal needs to be in your firm is you need to implement strategies that you control and that you constantly focus and manage to reduce that cash gap. So let me just put this out there as an example. First up, you sign a cost agreement. So there's nothing saying that you can't issue a fee at that time. But when, and that might just be outlined specifically in your agreement, that when we do the work, we estimate what the fee is going to be, and we issue a fee for 25% of that estimate, which you need to pay into our trust account. So you then 15 days later you might commence that engagement, and you might have 15 days later receive that cash which is sitting in the trust account. 15 days after that you've started doing the work, and you've done about a quarter of the work, so you're able to, and that's sitting in WIP, so you're able to draw that cash out of the trust account. 15 days later you might do another fee, second fee, receive the cash, finish the engagement, do the final bill, receive the cash. However it works for you, what you need to do is you need to create structure within your firm that has got multiple billing points on an assignment. As professional services people and practitioners, we often have this obscure view to when we bill our clients and how we bill our clients. But every other transaction our clients do, they do those transactions where they either pay up front, or they pay when they buy it, or they pay something when they sign up, or they pay as they go. Think about building a house. You know, a builder will just down his tools if he hasn't got his progress payment made. We have exactly the same opportunity as professionals with clients to structure our own cash flow systems and methods to make sure that we are aligning as closely as we can the cash coming in and the costs going out. So that's just a little example there. And the key to this is in your cost agreements. Now, it doesn't matter how many lawyers I speak to, there's always going to be a significant percentage of those lawyers that view cost agreements as an annoyance, as a bit of an impediment to them doing their business, form over substance. And the reality is that the legal industry the legal profession is one of the very few industries where by law, you have to provide them with an engagement at the front end. And with that cost agreement, whilst it's a legally binding document, it also presents you with the opportunity to run through the terms of how you're going to work with your clients. And in your cost agreements, you can stipulate how you're going to bill them, how they can pay you. You should be saying to them how much you estimate that it's going to be. And where a client says to you, yeah, okay, that's fine, that's great, I want to engage you, I understand your terms, if you use those cost agreements wisely, then what you're able to do is you're able to increase your billing cycle with clients and bill them more regularly so that they pay more regularly in smaller amounts, which, by the way, clients prefer to pay smaller amounts more regularly than pay one lump sum at the end or towards the end. And it actually reduces your WIP days, and it also reduces your debtor days. So it is your cost agreement and the engagement of clients right at the front end is the key strategy to driving your lockup down. There's no two ways about it. That is the number one action that you need to be implementing in your business around your cash flow management is strong, structured cash flow systems within your cost agreements. So let's put this into a little bit of context. I said before that we're a bit of an anomaly, professionals. That generally professionals look to bill towards the end of an assignment. What happens with most clients is that they want to buy a bottle of wine. They know how much it is and they pay it at that time and they go and consume it. They want to go on a holiday. Well, you don't pay for your airfares 45 days after you've got back from your holiday, or you don't pay for your accommodation 3 weeks or 60 days or 90 days after you've stayed at the hotel. You don't go and drive your new car out of the over to the showroom without having paid for it. And mind you, when you initially thought you were going to pay a price for a car, often it ends up being more because they have a system for taking you through to upsell. But you don't drive it out unless you've paid for it. So why should our businesses be any different? Why should a law firm be any different? Why shouldn't clients pay either upfront or more regularly as they're going along? So here's an idea of a cash flow plan. And these are 5 simple steps that you need to be focusing on when you implement your cash flow systems and strategies in your business. Firstly, you need a simple plain English cover letter attached to your cost agreement, which includes your billing timing. So very much it's in the face of it. You've still got your legal agreement behind it being your cost agreement, but you have a simple covering letter that says, this is how we do business. By you signing this agreement, this is how our firm does business. And every single transaction gets done the same way. Once you've done that, billing can become a bit more of an administrative function because it's stipulated. So if you've provided your estimate to your client saying this work is going to be $6,000, we bill you $2,000 at the commencement of the assignment, $2,000 3 weeks later, and $2,000 at the conclusion of the assignment. Those monies will be placed in trusts, and as the work is completed, we draw down on those funds. And if the client signs off on that, well, you can bill them accordingly. But what it does, it turns the billing system and the cash flow system into a process, not something that you have to do right at the end. It reduces that cash gap. So initial fee when cost agreement is signed, or some initial fee at the beginning when you're doing your work. Because you've got to remember, you do a fee for a client, it takes them a period of time to pay it. So by the time that cash comes in anyway, you're going to have done enough work on WIP generally to cover that fee. Get the cash deposited into your trust account. So it's not a matter of saying to clients, before we do any work for you, you've got to put the money in the trust account. For some clients, yeah, you've got to do that. Certain matters, you've got to do that on. But as a general system in your business, where you're doing a number of different things for clients, is that you get them to deposit that money into your trust account so you can draw on it when you're ready to. Then weekly, having a minimum weekly review of your WIP so that you can withdraw your funds out of the trust account. And then as a minimum, debtor follow-up each week for anybody who's outside of your terms. And generally your terms should be no more than 14 days. So those 5 very simple steps are what you need to be focusing on to drive improvements in your cash flow planning. And the overriding principle in cash flow management in a professional services firm is that the rules of your engagement must be designed to reduce the period between the engagement agreement and the cash collected. And I've highlighted there designed. You need to design them. You're able to create systems and processes and implement them that can reduce that cash gap. Don't just do what everybody else is doing. So let me just show you very quickly the impact that can have. So using those numbers we had earlier. So this is just a tool I use to review and our clients' revenue and help them develop and plan strategies to drive improvements around their revenue and profitability and also their cash flow. So the first part up there is really just looking at the revenue strategy, and in this particular firm, when we're looking at the cash inflows, this example had revenue of $950, driving that out to just under $1.5 million, so another $500,000 worth of revenue they were targeting in the following year, which was coming from 60 new clients, an increase in their transaction frequency by 30%, and an increase in their average sale of $15,000, put another $500,000 worth of revenue into their revenue line. These are also those numbers from those lock-up days we had earlier, so current WIP and current debtors. So there's 130 days there, so 357, which represents 36% of their revenue. Looking at growing their business by another $500,000 in revenue, if those WIP days were able to be brought down to say 30 days, and the lock-up and the debtors days were brought down to say 45 from 59, then there's a reduction in the WIP value of about $60,000. But what you've got to remember is this WIP value is less, but based on a higher revenue number. So when we have a look at the impact that has on the firm, in this instance, from revenue, it showed additional cash flow for that business of about $372,000. The profitability improved for that business of $385,000, and I've just done a valuation based on a 1x earnings. But the interesting point here is that whilst our profitability has grown by $388,000, our cash flow has also grown by $372,000. Whereas if you would have applied those same revenue days, WIP days and debtors days that existed, you can see there that WIP, that lock-up, has grown now to $515,000 on an increased revenue. And what that is going to do for your firm is going to put it under increasing pressure. So you still get some additional cash flow, but it's nowhere near as much as what you had before. So just to wrap up, and we'll go into some questions now if anybody has got any. So for anybody who's participated today in our webinar, thank you very much. We are offering that your registration fee for our webinar is only going to be $200, which for webinar participants is down from $350. We've got 25 seats only available. at this price. It's on the 17th of October. And basically what these webinars are designed to do is to give you a little bit of a taste and a feel for some of the strategies that you can implement in your firm. And with those strategies, you need to take time out to sit and develop them. And what you'll get in our Grow Your Law Firm workshop is 4 hours in a small setting where you can bring along by a number of seats and bring your team along to help you develop and review your firm and develop your strategies going forward around how you define and develop your revenue. So we'll be going through on that day, and we will be using this formula and applying it to your business to help you develop and come up with strategies and see what's possible. We'll be looking at cash flow strategies. We'll be talking about opportunities for how you go about defining your product, how you develop what your sales targets need to be and what your sales processes need to be, and also talk about marketing activities that drive revenue growth in your business. We'll then also be looking at what you need to be doing within your practice around driving your cash flow improvement. So it'll be very much a workshop style where we're going to run through each of those sections and develop those actions together. So all you need to do to register is to go on to growyourlawfirm.com.au and go to the tickets section and purchase those tickets. So that'll be at that price, $200 for 25 seats only, up till 5 p.m. Today. We're not going to have a webinar in October, only the workshop, which is on at the same time, but as always I offer a free 45-minute consultation on the numbers to grow your law firm for the first 15 people to email me after the webinar today. What we'll do is I'll get some numbers from you and we'll put it into that calculator and we'll talk over the phone around what's possible in your firm while we communicate, the numbers live on the screen. So what I'd like to do now is once again thank you all for participating and just open up if there are any questions. So just bear with me a sec. So now you should all be able to click on a little hand button there that if you've got a question, you just need to click on it, raise your hand, and I'll unmute you, and you'll be able to just ask. Or alternatively, you can type a question in and ask me anything you like. Okay, so any questions? Okay, well there we go, we've got one. So from Stephen, would the same principle be used in a firm with over 35 fee earners? Absolutely. Stephen, the impact of this principle is exactly the same in a 100 or 200 or 1,000 member firm, fee earner firm than it is to a sole practitioner. The key with driving your revenue strategies must be focused on what you do before you win the work. And then once you've won the work, you're then able to do it. As I said, the charging hours formula of full-time equivalent fee earners, productivity rates, charge rates, recovery rates is still valid, but it's valid when you're doing the work. It also might be valid around how you price the work, so how you prepare your estimate. But the key on driving your revenue strategies is to sell services to clients, to get those clients engaging with your business, and then getting them to sign up on that cost agreement. Then, with from a cash flow perspective, it's exactly the same principle. It's what do we do, what is our policy in our business for bringing our billing cycle forward, or what is our policy in our business for, and our policy in our business for cash collection. and the size of the firm doesn't matter. I also note that most firms where there are multiple principals in the firm, usually over 4 principals in the firm, sometimes 3, that those firms often run as individual silo practices anyway, where they have their own teams and there's not a great deal of cross-selling. So within those firms, they really have a number of different smaller firms that have to go and hunt and find their own work as well. Stephen, I hope that answered your question. Any more questions? See if anybody's raised their hand. Nope. So if there's no more questions, we might leave it there. So thank you very much for participating today, and looking forward to seeing you at a future webinar. If you'd like to get more information, visit elliotsgroup.com.au or go and register for our next workshop on the 17th of October via growyourlawfirm.com.au. 25 seats available. Thank you very much.